China's economy is hitting its growth targets, but if you look closer, the story gets a lot more complicated. It's an economy running on two different speeds. And understanding this split is key to figuring out where China and the world are headed next. Let's start with the big picture. China's factories are running full steam, pumping out goods and sending exports all over the globe. This export machine is the main reason we're seeing positive growth numbers. But step inside China, and the story flips. Domestic demand is weak. People just aren't spending like they used to. This creates a massive imbalance. All that production has to go somewhere, and when it floods global markets, it creates pressure and trade friction abroad instead of building stable prosperity at home. A huge part of this internal weakness comes from the property market. For decades, owning a home was the primary way Chinese families built wealth. But now, the property sector is in a prolonged slump. Confidence has evaporated. When people see the value of their biggest asset falling, they get nervous and pull back on spending. This has a ripple effect. Local governments, which rely heavily on selling land to developers for their revenue, are now facing serious financial stress. This crisis in real estate isn't just about empty buildings. It's shaking the financial foundation of both households and local authorities. This brings us to a critical point: household confidence. When people are worried about their future income and the value of their savings, they do the rational thing: they save more and spend less. This is exactly what's happening in China right now. No matter how many incentives the government offers to encourage spending, it's a tough sell when people feel insecure. And here's the challenge for policymakers. Stimulating factories with loans and subsidies is relatively quick and easy. Boosting the confidence of hundreds of millions of households, that's a much slower, more complex, and delicate process. This puts Beijing in a classic policy dilemma. Do they focus on boosting domestic consumption, a path that is slow, politically sensitive, and requires deep structural reforms? Or do they double down on what works quickly, export-led growth? So far, they've leaned towards exports. It's the faster path to hitting growth targets, but it comes at the cost of increasing tensions with trading partners in Europe, the US, and elsewhere. The choice they make here has enormous consequences for the entire global economy. You might be wondering, why not just launch a massive stimulus package like in 2008? The simple answer is debt. China's overall debt levels are already very high. Authorities are extremely cautious about repeating the past and reigniting property bubbles or creating wasteful investments. The era of flood-like stimulus is over. Instead, we're seeing much more targeted, cautious support aimed at specific industries, not a broad-based bazooka aimed at the whole economy. This reliance on exports is leading to a massive trade surplus for China. When a country sells so much more than it buys, it puts downward pressure on its currency and can trigger retaliatory trade policies from other nations. We're already seeing this with tariffs and investigations into Chinese goods. This friction isn't just about economics. It increases geopolitical risks and makes the global landscape more volatile. This export push also has a direct impact on manufacturing prices worldwide. With so much production capacity, Chinese factories are able to produce goods at very low prices. This deflationary wave puts immense pressure on manufacturers in other countries who struggle to compete. It affects global inflation trends and forces other governments to rethink their own industrial policies and supply chains. Are they too dependent on China? Should they protect their own industries? These are the questions being asked in capitals around the world. Finally, let's touch on commodities. The slowdown in China's construction sector means less demand for raw materials. We're talking about everything from iron ore and copper to oil and gas. For countries in South America, Africa, and Australia, whose economies depend on selling these resources to China, this slowdown is a major headwind. It impacts their growth, their currencies, and their economic stability. So, as we look towards 2026, China's path is defined by this internal struggle. Will it succeed in rebalancing its economy toward consumption, or will it continue to rely on an export model that creates friction abroad? The answer will shape not just China's future, but the entire global economic order. Thanks for watching, And if you found this breakdown helpful, be sure to like and subscribe for more deep dives.